This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Now, in every one of the income tax computations that we have prepared so far, we've seen the deduction of the personal allowance. That personal allowance for our tax year is £11,500, and we know the order in which it is deducted. It is deducted firstly from non-savings income, if relevant then to savings, and thereafter dividend income. That's our order of deduction. But that £11,500 personal allowance that, to begin with, every taxpayer in the UK has a right to, may become limited or indeed even entirely lost due to the level of the taxpayer's so-called adjusted net income. Now, we know what net income is. We'll revise that in a moment's time. We've seen it on the pro forma. Then there is this new term, adjusted net income. More of that again in a moment's time. So, looking at our notes now in section 3 of chapter 2 on the personal allowance. We know what it is. It's a level of tax-free income that's available, to begin with at least, to all UK taxpayers. We know that it is deducted from net income. To derive, of course, the figure that we're looking for in the first part of the computation, our taxable income on that pro forma income tax computation. We know the order in which we deduct it from our analysis columns, and as it says here, firstly against non-savings income, that is usually big enough, of course, to absorb it there, but followed, if necessary, by savings, and then finally dividend income. We equally know, and it's given, of course, to us on our rates and allowances page, that our normal personal allowance for our 17-18 tax year is £11,500. Now, we've made mention of the fact that if our net income, our adjusted net income to be precise, exceeds a certain limit, then we may lose either partly or entirely our personal allowance. And we've now got to see how that restriction of the personal allowance applies. If an individual's adjusted net income, more of that in a moment, exceeds £100,000, there is our so-called income limit. That £100,000 given there is also given, of course, on your rates and allowances page. Again, next to the information about the personal allowance, you'll see an income limit. They won't tell you how to use it, but they'll give you the figure of income limit itself, that being 100,000. And then, if it does, then the personal allowance is reduced by. Now, here's the bit that you are going to have to learn. We will take our adjusted net income minus the income limit of £100,000 and take a half, 50% of that figure, half of that excess of adjusted net income over the income limit of £100,000 becomes the reduction. Now, as that is a proportionate figure, we say once adjusted net income is therefore £123,000 or more, then the personal allowance is reduced to nil. Look at what that reduction would be if we had an adjusted net income of 123. We would have, following this calculation here, half times adjusted net income, assume it's 123, minus the given income limit, 100,000. That excess of adjusted net income over income limit is 23,000. Half of 23 equals 11,500. So you would be reducing that personal allowance of 11,500 by 11,500 and be left with nothing. So any adjusted net income figure from 123,000 upwards, doesn't matter then how high it is, simply means that there is no personal allowance available. It is entirely foregone. Now, of course, what is maybe more likely to find in an exam question, maybe a specific little objective testing question, an OT question there for you, is one where the adjusted net income is something between 100,000 and 123,000. First thing, of course, you've got to do is to calculate that adjusted net income. So what is it? We know what net income is. It is total income less any qualifying interest payments and any relevant trading loss reliefs. That was on your pro forma income tax computation on page 5. Again, what we have seen hitherto, and until we get to section 4, that total income and net income have been the same. In section 4, we'll have a look at qualifying interest payments. There are very few of them. And when we get to chapter 7, we'll look at the relevant trading loss reliefs that will again reduce our total income down to the net income. But then we've got this figure, adjusted net income. Now, it's going to be a bit tricky for a moment here, but will be sorted out just a little bit later in this chapter. But what is it? Adjusted net income is obviously, we start with the net income figure less. And we're going to reduce it by either or both of two figures. An individual during the tax year may pay into their own personal pension scheme. And if so, we take the gross amount of any personal pension contributions and reduce the net income by that figure to give us adjusted net income. Now, what we mean by net and gross, we sort out later in this chapter. We'll revisit it again when we look at chapter 10 indeed, that is entirely devoted to just looking at pension contributions and how it is and where it is that we gain any tax relief in relation to the payments made. But here we would be looking for one specific thing, personal pension contributions, and don't worry about what that means at the moment, we'd be looking to deduct the gross amount of such personal pension contributions. Again, in just a lecture or so's time, we'll be seeing that issue. What the individual may also pay out during the year, the individual may be generous and therefore make gifts to charity. And if the individual makes gifts under the so-called gift aid scheme, again, this is in section 5 here of this chapter, so we'll see it very soon, then any such gross gift aid payments reduce our net income down to our adjusted net income. Now, because we haven't yet got to section 5 in the examples that we're about to follow, we'll discover that the net income is one and the same as the adjusted net income, as of course it may very well be in an exam question, as it probably is in very many cases in real life as well. When we come to section 5 and we understand more about the way in which we deal with personal pension contributions and gift aid payments and the tax system that applies to them, we'll revisit this area and do further calculations involving the computation of adjusted net income. So you will see those items coming in. But to begin with, just using net income as the adjusted net income, which as I said, in many cases it will be, how do we then apply this calculation? It's very simple. Right. Example 8. Mike's got gross employment income. Gross employment income, salaries, wages will always be quoted gross, i.e. before deduction of PAYE. We're told here that £33,130 was deducted at source under PAYE. Why so much? Well, he's got a very large figure of employment income, £108,000 in our tax year 17-18. Now we can see we have got one source of what is non-savings income, employment income. It is £108,000. No other sources of taxable income, and there are no, as I promised there wouldn't be here, there's no personal pension contributions and there's no gift aid payments that have been made. So what we have, therefore, is a situation where the individual has total income and net income amounting to £108,000. Again, if we were doing our full pro forma computation, we'd have non-savings, we'd have total, and we would include our salary, our employment income, and that would bring us down to a net income before the deduction of the personal allowance amounting to £108,000. Now, as soon as we see that our net income, and given that there are no further deductions from that, our adjusted net income has exceeded £100,000, we know that there's going to be a restriction in the personal allowance. There'll still be some personal allowance available to the taxpayer, because at £108,000 there, that of course does not exceed £123,000. So there's a restriction in not only the entire removal of the personal allowance. So I'd always recommend putting your personal allowance into a working, and of course when you've got it, That will bring you down to taxable income, and then we can proceed to tax that figure of taxable income. But we need a working now to show how we get the personal allowance figure. So quickly therefore, let's just go to a separate page and do that calculation. So working one for the personal allowance. Now we know that the taxpayer starts off with an entitlement to a normal personal allowance of £11,500, but that is restricted. Less. Again, look back at the calculation if you need to. It was half of the difference between adjusted net income and the income limit of 100,000. What is our adjusted net income? The same as the net income. There is only one figure of income, it is the salary figure, and that was £108,000. Well, of course, 108 minus 100, that's 8,000. Half of that, 50% of that, is now our restriction, so that will be £4,000. Take it away, and we are looking at a revised personal allowance of £7,500. Having got that revised figure, back we would go to our computation, 7,500 to come in, bringing us down to taxable income of what's that going to be, £100,500, all of which, as we know, is non-savings income. We would then proceed to calculate the tax on that non-savings income. So all of it non-savings, very simple therefore, basic rate and higher rate would be applicable. Basic rate band limit, 33,500. That therefore would be at 20%. How much are we taxing overall? £100,500. So we've got 33,500 already assessed. Take that away from 100,500, and I think we're looking at some £67,000, all in the higher rate band of 40%. And you calculate your tax liability accordingly. Given that they want here income tax payable, then we know that that PAYE figure would then have to be deducted from that. Now you again can check the model answer to that in a moment's time, but the key issue there was how it was that we computed our revised personal allowance in this working one. Again, start off with our normal entitlement, £11,500, and then reduce it by the restriction. This is the bit that you have to remember. A half of the excess of adjusted net income, that is the figure that you may have to work and may be rather more difficult to compute in other circumstances, as we'll see when we move to section 5 of this chapter. Minus the income limit, a figure again you'll probably remember by the time of the exam, but it's given on your fact sheet, your rates and allowances page if needed. Get your revised personal allowance back to your income tax computation, and then it's business as usual. Again, checking, do they want income tax liability? Do they want income tax payable? Now we've got, well, we might say a slightly more interesting example in terms of example 9, given the level of income now the taxpayer has, which, as you'll see, I hope you'll see, will clearly make the taxpayer an additional rate taxpayer. Look at what Ken has got. Trading income, 130. Trading income, non-savings. Bank interest of 40. Savings income. And, oops, where's that gone now? Here we go. Dividend income, obviously dividend there, 36,000. Now you look at what those figures add up to. Again, if you were doing with a full pro forma computation, you would show that. You have got all examples of your income. You've got 130 plus 40 is 170 plus 36, therefore £206,000. That very clearly means that as your net income is 206, there are no deductions from that in the form of gross personal pension contributions or gross gift aid payments, whatever they are. We see them later, remember. So our adjusted net income is 206. Now, there is little point doing the calculation of the revised personal allowance and showing the deduction of half of the adjusted net income minus 100,000. All we need do in our answer when we show that the personal allowance is nil is put a little note to say that as adjusted net income exceeds, what was the figure, the cut-off? £123,000. As adjusted net income exceeds 123,000, the personal allowance is reduced to nil. So then all you've got to do is to calculate your tax on these figures now of not just income, total net income, but also taxable income. You'll start with 130. So you'll use up all your basic rate band, you'll then move into higher rate band. Then you'll move to 40. When you add 40 to 130, it takes you up, of course, to 170. That is above £150,000. So you now move into additional rate. So half of that 40,000 will be at 40% higher rate. Half of it will be at the additional rate of 45%. We then move to the dividend income. What does dividend income, whatever level of taxpayer you may be, what does dividend income firstly enjoy the use of? The dividend income nil rate band. So of that 36,000 there, 5,000 of course is at zero, at nil rate. The remaining 31,000 that is still taxable, you're up now into additional rate. There's that very weird and wonderful figure, 38.1%. Now, I'd like you to check through the answers to both of those examples. Again, remember, we will, following section 5, then deal with examples such as this, where a restricted personal allowance applies, but in the more interesting circumstance of the taxpayer having actually made in the tax year either gross personal pension contribution payments and or gross gift aid payments. We'll look at that later. For the moment, please just pause this and again check through the answers to each of these two examples, 8 and 9, and then return to us, please. Okay, well, hopefully you've fully reviewed through the answers to those two examples there, 8 and 9. And it was that last one, example 9. Now, I quickly talked you through it, and I hope that you picked up the method of computing the tax on the savings income. Now, when we've been dealing with savings income up until now, we have, of course, had to worry about not only the 0% starting rate band, which clearly wouldn't be relevant here given the level of non-savings income that exists, but then also the savings income nil rate band. Because in every other circumstance up until now, the taxpayer has either been a basic rate taxpayer or a higher rate taxpayer. But now, very clearly, based on this figure of income, our taxpayer is an additional rate taxpayer. Now, if you can't remember it, go back again to the notes on savings income early in the chapter, and you will hopefully there recall that if you are an additional rate taxpayer, then you get nothing in the form of a savings income nil rate band. Additional rate taxpayers get no savings income nil rate band. Unlike the basic rate taxpayer getting £1,000, the higher rate getting £500. So that was why when we spoke of that 40,000, having already taxed 130,000, 20,000 of the higher rate band limit remained. The remaining 20,000 of the 40 was to be taxed at the additional rate. There was no savings income nil rate band to apply. Other than that, the dividend income, 5,000, always applicable there, no restriction in it. As we said, whether your basic, higher or additional rate, 5,000 dividend income nil rate band is always available to you there. Okay, with that in mind and the treatment of the savings income in particular, I now need you to have a go at, all on your own, example 10. Have a look at what the situation is. We need income tax liability. Got a trading income, so non-savings assessment of 102,000 and bank interest of £4,000. So we've got both non-savings and savings income. The combination of those two is £106,000. Here the net income is the same as the adjusted net income, and on that basis we'll face a restriction in our personal allowance. Again, you can probably compute that very quickly, if not in your head. We know adjusted net income is 106, the income limit is 100,000. That's an excess of 6,000. How much of that is the restriction in the personal allowance? A half of that excess of adjusted net income minus 100,000. 106 minus 100 is 6,000. Half of that is 3,000. Take it away from your 11,500. You'll have the revised personal allowance. All of which will be applied against the non-savings income. But when you then come to tax your savings income, although of course, as we've said, there's no starting rate bound to take advantage of, the taxpayer is a higher rate taxpayer. Therefore, this taxpayer, James here, will benefit from some savings income nil rate band. Over to you, therefore, to be able to calculate what that figure of income tax liability will be and deal correctly with the calculation of the tax on the savings income. Okay, again, if you pause at this particular point and then rejoin me in a few moments' time. Also, of course, I've now realised that I've actually started this session talking about the personal allowance. I missed out the last bit of section 2, the accrued income scheme. We'll go to that next, so apologies there if you've been thinking what happened about the accrued income scheme. I'll go back to it next. Take a small break at this point in time. Just pause, please. Okay, well, finally in this particular session, rather than firstly as it should have been, we go back to section 2.3 in your chapter 2 notes here on something called the accrued income scheme. Now, we all know what the accruals concept is from our financial accounting, our financial reporting studies. What's going on here? Right. It's still to do with interest income, savings income as we know it. And there are two types of taxable interest income that we may see within an exam question, other than your basic, which we've probably had in most examples up to now, either bank deposit interest or building society interest. And these two forms of interest that you've got to be on the lookout for are these. Interest from government securities, otherwise known as gilt-edged securities, and then interest on what is normal corporate loan stock, or again to give it its proper name in tax terms, which are the main form of qualifying corporate bond. Now, interest income from either of these two sources are taxable sources of income, so they need to be included as savings income on our income tax computation. But there's an issue about them. These securities, when sold, are exempt from capital gains tax. So when we sell these securities, there's an exemption from capital gains tax. And what this meant before this so-called accrued income scheme came in, there was an advantage for a vendor to be able to sell these securities shortly before the amount of interest payment fell due upon them. Now, the fact that there was another interest payment due in the very near future meant that the value of those securities would be increased to take account of the fact that an interest payment was pending on those securities. So what would happen is that the taxpayer would get more as sales proceeds for the disposal of the security when made just before the due interest date, and would effectively allow the taxpayer to convert what would have been taxable income had they received that interest into a non-taxable gain when it has served to instead increase the sales proceeds on the disposal of the security. Now, that's the reason for having this particular scheme. You don't have to worry about the reason for it, but you have to deal with the mechanics of it. So what happens here? How do we deal with it? Point, as I've said, a taxpayer would be able to avoid income tax on interest income if that security was sold just prior to the interest being payable by effectively converting what would have been taxable income into an exempt gain. Now, here's an example to illustrate. So, we are told that our taxpayer on the 1st of July 17 purchased £120,000, that's the, give you a nominal value of that, of 2.5% per annum exchequer stock. An example, probably the most likely one if they're going to give this, of a government security. This, therefore, would generate taxable interest income. What would that taxable interest income be? 2.5% on the nominal value. And they bought that, or here the taxpayer bought it, at a cost of £125,000. Yeah, we get the point here. Oh, pardon me. Oh, yeah. Are we going to sneeze? I'll try not to sneeze all over the camera here. Oh, right. What we get is the situation where the market value of an interest-bearing security is not necessarily the same as the nominal value. Any interest payments are based on the nominal value. The market value on such a marketable security will be a function of what interest rate is applicable to it, here 2.5%, as compared to interest rates available in the market. If this is a higher interest rate than was currently available in the market, then that would mean that people would be willing to pay somewhat more for that particular security than the nominal value because of the interest that will be generated therefrom. If this was a low figure, then people would be willing to pay less than the nominal value of £120,000. So presumably here, if the nominal value is 120 and we're actually buying it for 125, 2.5% represents a healthy interest rate as compared to what was otherwise available, which at this point in time when I speak in early 2018 is probably about right. However, interest was payable on, as I said, the nominal value at the 30th of June and the 31st of December in each year. So we would have 2.5% on £120,000 broken down into two half-yearly payments on the 30th of June and on the 31st of December. Now, this taxpayer bought on the 1st of July 17, so the interest payment due on the 30th of June was already paid. That went to the vendor, and the vendor would have been taxed upon it. This individual now, as we'll see, doesn't actually keep it all the way through until the next interest payment was due. But on the 1st of December 2017, the taxpayer sold the stock for £127,000, including the accrued interest. Now, wherever this is tested, the accrued income scheme, they're going to tell you that the security was sold and it included, the sales proceeds, included this amount of accrued interest, included the accrued interest. So what do we do? The disposal, as we've said, is exempt from CGT. But now, under the accrued income scheme, the following amount will be treated as income and included in the tax computation for this, the 2017-18 tax year. The point at which we sold was, we go back to our example here, on the 1st of December 17, had acquired on the 1st of July. Now, interest was payable half-yearly at 30th of June and 31st of December. So the amount of accrued interest at the point of sale the 1st of December, 1 month before the 31st of December, where a 6-month amount of interest would have been paid, we're going to have £120,000 at 2.5%, the nominal value times the annual interest rate, times at that date, the 1st of December, how many months' worth of accrued interest were there, which would have effectively been accounted for within the sales value of £127,000. Answer, 5 months. Therefore, we do that calculation. Hopefully they're done correctly. 5 months' worth of 2.5% on 120,000 is £1,250. And that figure will be included as interest income, savings income, in the income tax computation of the taxpayer who has sold that particular security. What happens to the buyer? Well, of course, the buyer will receive at the 31st of December. The buyer now owns that security, so the interest payment due on it will be paid to them. How much was it? It would have been £1,500. the 120,000 at 2.5% times 6 months. Remember, it's paid half yearly. So at the 31st of December, you receive interest off the government of £1,500. But he, the buyer, won't be taxed on all of that £1,500, will only be assessed on £250, because the £1,500 in total there for that full half year, we have already, under the accrued income scheme, assessed £1,250, there's your £1,250, on the vendor of that security. So the vendor has been assessed on £1,250, the buyer is then assessed on £250, and there's the £1,500 worth of interest accounted for between the two taxpayers. So you've got to look out, therefore, on a sale of such a security, whether it's a government security as here, whether it's a corporate loan stock. You have to look out for the fact that when they tell you how much it was sold for, that it included accrued interest. Pardon me a moment there. That it included accrued interest. And you then have to work out how much accrued interest was involved using the type of calculation done there. That figure will then appear as income on the individual's income tax computation for the tax year concerned. Okay, have another look through that, make sure that you're happy with it. That brings this particular session to an end. Sorry, I got it the wrong way round there. We having dealt with the personal allowance first, but now we've covered again those two particular areas. In terms of the personal allowance bit, the restriction of the personal allowance, we'll be revisiting that area again when we come to section 5 in these notes. So join us again in our next session, please.